Well, good morning and happy Tuesday, the 12th of November. We're getting closer and closer to the holidays on a daily basis, and the markets are moving. All right, so what's up this week? We got Jerome Powell speaking. He's speaking on Wednesday. He's speaking on Thursday. We have also jobless claims and PPI. The main reports are going to come out as usual later in the week. Keep in mind that Jerome Powell already lowered rates 3 times this year. So what he's saying now is not going to impact this year, and therefore it's not going to impact the economy or the markets as much as it would had he not lowered rates 3 times this year. So don't expect too much from Jerome Powell. Try to figure out where he's going. I believe what he's going to be saying is we'll lower rates if we have to, but at this point we're just going to hold on and see what happens with China and US. That would be the most probable scenario. Jobless claims coming out on Thursday. Not expecting anything crazy. Expect a number, again, between 205,000, 220,000. They've been fairly, jobless claims have been fairly consistent over the last several months. So I'm not really expecting anything major or major surprises. But again, the biggest reports this week is not going to be the report, but the tone of Jerome Powell, and that's going to happen on Wednesday and Thursday. CPI is going to be a big report. That's going to happen Wednesday. So Wednesday and Thursday, and possibly Friday, depending on what happens Wednesday and Thursday, you could see potentially a good amount of volatility on the overall market. Now, let's talk about the market. The S&P 500 is not moving higher. It's been grossly overbought now for about 5 sessions, and there's really no catalyst to cause it to go higher. The catalyst last week and the week before was hopes that China is going to work things out with US. Trump came out over the weekend and said some of the numbers have been misquoted, and he's having a meeting today at the Economics Club in New York. So hopefully we'll get a little more news or a little more communication from him on where we stand with China. But I'm not keeping my breath. I'm not holding my breath for a resolution. I think it's going to take a lot longer, and I think, as usual, the media and possibly our president is oversimplifying the situation because it's a complicated process. It's going to take a lot of bean counters, and it's just not that simple to solve. There's a lot of moving parts. So I believe this action right here is hoping that China and U.S. will resolve their differences, but I believe it's much, much, much too early. Now, Earnings are about 90% done, giving us a really good picture of what's going on. Earnings are down about 2.4% from a year ago. If you hear about the expectations and the prognosis, you're going to hear really positive things. So why are you hearing positive things, and why are the numbers actually down? The reason you're hearing positive things is because the expectations were so much better than expected because the numbers have been knocked down. Over the last 2 years, we've seen a small slowdown in earnings and numbers because of China, because the economy is maturing a little bit right now at this stage in the economic cycle. So economists and analysts, they've been beating the numbers down. And when the numbers are beaten down and when they're actually come out better than expected, it's a positive surprise. So the market's holding on to the positive because of the lowered expectations. But in reality, the numbers have been kind of mixed and a little bit lower than last year. So I wouldn't make too much out of it. Again, the reason the response to the numbers is better than expected is because they've been beaten down by analysts so much that just a heartbeat a heartbeat would give us better than expected numbers. So don't look too deep into the actual number. Always look at the expectations, but know that GDP hasn't really risen above 2%. It's actually lower than 2%. That's the gross domestic product. Excuse me, it's too early in the morning here to speak fancy language. And the earnings are down 2.4% from a year. So are we really growing, or are we kind of staying at a stable position? And remember, the market always looks for things ahead of time and discounts everything that's known. So if there's nothing better on the horizon, and if we don't see China and U.S. Resolving something, if we don't hear positive tone Or if we hear something from Jerome Powell later in the week where he says, hey, if China and U.S. resolve, we're going to raise rates, because that can happen too. Remember, they've been lowering rates in anticipation that U.S. and China are not going to resolve anything. So it's a tricky situation. So don't get too happy if U.S. and China start getting positive resolutions, because the Fed is going to start taking away or increasing rates. So there's this balance right now. And anytime this balance will be disrupted, the market will go down. And I'm expecting it right now, based on the overbought territory, to move back down to the 50-day line or the support level, which is right around the 295 level. Now, before I let you guys go, keep something in mind, and this is what I'm focused on right now. This should be the dead giveaway. This is the Russell 2000. If it's trading below the highs, there's very little reason for the overall market to rally. As a matter of fact, the odds of seeing a major rally in the S&P 500 is zero if the small caps are not participating. Why? Because for the most part, stocks are not doing that great. It's just a handful of stocks in the S&P 500 that's causing momentum to rally. So if the small caps are not participating, and look here, they haven't really been participating in over a year. It's been just a sideways channel, except for this little fiasco last November. We don't talk about that. But anyhow, they're waiting for the market to break out and China to be resolved. There's too much vulnerability with small caps and China. So I'm expecting this to continue moving sideways, just like it's been here, till we see a resolution, or till the small caps start seeing a resolution. Very important. Pay attention to that. This is what you should be focusing on right now. Why? Let me show you something eye-opening. I know the S&P's at new highs and everybody's happy and everything's looking great, but let me show you something scary here. This is the percentage of stocks in the overall stock market, not in the S&P. Only 55% of stocks are trading above the 200-day moving average. 45% of stocks in the overall stock market are trading below the 200-day moving average, which means they're bearish. So if you look at the overall stock market, it's barely got a heartbeat. But if you look at the S&P, it's making new highs because of a handful of stocks like Amazon, Apple, and so forth. They have a large market cap, and I've explained that several times. So before I let you go, I want to talk about something really, really important. As a trader, it's really important that you diversify your portfolio, especially when markets aren't really giving you a lot to work with like this. You want to diversify. You don't want to put all your eggs in one basket. That's a beginner's mistake. Don't do that. One portfolio, one program we have is completely diversified from the US stock market. As a matter of fact, it doesn't even trade stocks. It trades currencies and gold. And currencies and gold typically rally when stocks go down. So there's a really good natural hedge. Now, what you're looking at is the FXC. That's the euro currency. And again, if you're looking to trade something that doesn't have a lot of correlation with the US stock market, this is it. So check this out. We went short. We bought a put. We bought a 106 January put on the 4th. We paid about $1.02 or $1.06, and it's been moving steadily lower. And right now, looks like it's going to open up about flat. But if you look here, the 106 put, it's right around 150. So it's up about 50% in let's see how many trading sessions. 1, 2, 3, 4, 5 in 5 trading sessions. Folks, can you imagine making 50% in 4 or 5 trading sessions with zero correlation to the US stock market? That's what you got to do. That's what you have to do in your portfolio. Whether you trade the S&P successfully, whether you want to diversify, whether you want to increase your hedge, diversification is the only free lunch on Wall Street. So again, we have a system that trades gold and currencies, ETFs. So you could still trade all of this with a stockbroker. Ticker symbol for gold. And you should know this anyway, because gold is a great hedge for your portfolio. So it trades gold, no correlation to the stock market. Gold looks like it's about to break down. It trades euro currency. And again, there's nothing like diversifying your portfolio. Look at this downtrend. Just looks like it's going lower. Stocks at a new high, euro currencies at new lows. Again, we trade this to the long side, to the short side, and this gives you complete diversification. Zero correlation with the stock market. You got to check this out. It's a currency and gold ETF system. If you want to learn more, click the link below. Learn more about it. I hope you guys are having a great day. Keep your eye focused on what the Fed and Trump says. And don't forget to check out this currency and gold system that has no correlation with the stock market. 50% return in like 4 or 5 days. That's amazing. Check it out. Click the link at the bottom of this page. I'll talk to you guys soon. You guys have a great day. Bye.